Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Crocs, they just had their Q1 earnings call. Stock is up about 5.5%. This has been a good performer for me. This is a top 10 holding in my portfolio. I was a big buyer in the $80 to $90 range. Now that it's trading in the 130s, I want to see if it makes sense to revisit that valuation, whether to hold, buy, or sell, that sort of thing. Year to date, up 42%. 1 year out, up about 14%, kind of an up and down cycle. Again, I was kind of a buyer here in the November area. 5 years out, really good return for investors. At the end of the day, this is still trading at a relatively good valuation on paper, 10% free cash flow yield. If you think about comparable companies, something like Nike or what have you, obviously Nike is a much bigger brand, a much better brand from a cachet perspective, trading at a 5% free cash flow yield, growing at about the same clip, low single digits, and has margins that are about half of what Crocs has. So for Crocs to trade at half the valuation of Nike when it has double the margins seems kind of weird, which is what interested me in the stock in the first place. And that kind of continues to be the case. The valuation hasn't really jumped that much. It's just that the company has continued to grow at a decent clip. Their Q4 earnings were pretty solid when they gave their Q1 guidance for Q4. During Q4 rather, they were kind of aiming for about flat growth for Q1, 6 to 8% growth on the Crocs brand, negative 23 to negative 20% growth on the Hey Dude brand. I think that's really what's keeping the stock down. That Hey Dude brand is kind of a turd, if you will, when it comes to their performance since they acquired that in 2021. They took on a bunch of debt to do that. Might have been better off just not acquiring anything and using their cash flow to buy back shares, but they did it, so it is what it is. And then for the full year basis, 3 to 5% growth, flat growth on Hey Dude, or no growth on Hey Dude, 4 to 6% growth on Crocs, and then adjusted operating margins for Q1, 22%. So now as we look at the actual results, remember 0% growth expected, about 7% growth actually realized. Really amazing growth on the Crocs brand, plus 16% growth versus the 6 to 8% that they expected. International grew in the mid 20s. North America still growing in the high single digits. It's just Hey Dude, which again was expected to shrink at about 20%, is shrinking slightly less at negative 17%. But they did say that Q2 results aren't looking as good as they hoped, so that might be an overhang for the rest of the year for Hey Dude. So at the end of the day, it comes down to Crocs brand, amazing. Hey Dude brand, flush it down the toilet, that sort of thing is what you've got going on. And the nice thing about the results is they were expecting 22% growth, operating margin rather. They achieved 27.1% operating margins, and that leads to a pretty big beat on the diluted EPS side with a $3.02 per share versus a $2.25 projection on the high end. So overall, really good results, but it doesn't assuage your concerns about Hey Dude being kind of a crappy acquisition for them. They did just bring in their former chief marketing officer who worked at Stanley for a while. Stanley, those crazy bottles that people are buying a lot of these days. He really did a good job there making that thing a viral sensation. So maybe bringing him back will kind of right the ship on the Hey Dude brand. But at this point in time, Hey Dude's not really doing that well. At the end of the day, this is still a Crocs facing brand, and I mean that really makes sense when they have shoes like this coming out. You've got a Pringles can that you can put into a little pocket for your Pringles boots. I mean, you can't miss with that. That's clearly why the stock is doing so well, because they got awesome releases like that. Can't miss. Internationally, this is growing really well. That's kind of a good growth story for Crocs, growing superbly internationally, and it's especially true in China and Australia, where they basically doubled their growth quarter over quarter. So again, really good growth on the Crocs brand. You got a bunch of franchises. They do a pretty good job of making these collaborative releases like that Pringles release that do sell pretty well. And it's kind of this stylistic thing that they have where it's unique shoes, unique looks. Some people may think those shoes are ugly, myself included, but they're comfortable. A lot of people like them. Kids like them. Adults like them. They've got a really good brand out there and a lot of good noise. And they've done a really good job marketing these things with these unique releases that other brands can't seem to match. And it's a question as to whether or not they can push that marketing know-how into the Hey Dude brand and get that growing again. Because if they can, this could potentially be a really good valuation, because Hey Dude is struggling. Yes, it exceeded the high-end guidance of negative 23 to negative 20%, but it still shrunk at 17%. They opened some outlet locations. They have some franchises that they're trying to grow. They're also starting to kind of release these unique shoe combinations. They had a Big Lebowski shoe that came out. They had some collegiate stuff that they're partnering with schools on. But at the end of the day, this is still a brand that's struggling. And it's kind of struggling on purpose from a results perspective. They pulled back on some of their discounting. They wanted to maintain pricing integrity. They pulled back on some inventories. They kind of made sure that the wholesale partners that they're working with are the right partners, because some of the stuff was ending up on the gray market. And they're also opening up some more outlet locations in the next 12 months as well, to trying to leverage what they did in growing Crocs on the Hey Dude brand. It's a question mark as to whether or not that will pay off, but clearly they did something right with Crocs. If they can repeat at least part of that on Hey Dude and get it back to growth, this could be a really good value story based on the valuation it's at today. So again, Q1 results really solid. Crocs margins actually improving. Hey Dude margins shrinking, but overall margins for the business improving, which is good to see. And this is really the story here. This is a business that produces a ton of free cash flow. A lot of that money flows down to the bottom line because this is a high margin business, kind of plasticky, whatever material these shoes are made of, selling for $30 to $50. They're still kind of in that sweet spot where inflation hasn't impacted them too much. Actually, their costs have gone down. Their cost inputs have gone down a little bit, as they mentioned on the call, for their Crocs brand at least. And I think, if you're kind of looking at shoes in that $20 to $30 to $40 to $50 range, it's a lot easier to spend money on stuff like that than it is on $100 plus sneakers when your wallet is impacted by other costs going up. So I think they've done a pretty good job there. Inventory balance is looking really good, so that sell-through is right there. And their allocation priorities aren't really changing. They're using 2024 as an investment year to kind of grow their brands. I think really they've put some new leadership in place for Hey Dude. It's going to be a key year for investors to see if they can kind of turn that around. Right now, it's looking like 2024 is going to look kind of bad in relation to what they guided for during their Q4 earnings. But maybe 2025 will be set up well because of the investments they're making in 2024. They're going to continue to pay down the debt that they took on when they bought Hey Dude. I think they still have about $1.7 billion left in borrowings, but they paid off almost $1 billion last year. And then they have almost $1 billion left in a share repurchase plan that they're continuing to use. I think there's going to be, more debt pay down coming in the next 12 months, and then eventually more of that money will transition towards buying back shares versus paying down debt as they get to a good spot there. So as you look at their Q2 guidance, you can kind of see kind of negative on Hey Dude. I think they were expecting that to kind of improve as the year progressed, because if you look at their full year guidance, they were kind of expecting flat to slightly up growth for Hey Dude for 2024. Now it's -10 to -8. They're seeing some negative things happening in Q2 already, so they're really guiding towards negative growth, which is why their overall revenue growth is not changing, still staying at 3 to 5%. It's because Crocs is growing faster, but Hey Dude is shrinking more than they expected. The nice thing to see is that their operating margins are still really solid. Again, they guided for 22% for Q1, beat that substantially in Q1 2024. They're guiding for 26.5 in Q2, which means that in Q3 and Q4, they're probably expecting some margin pressure. To me, that seems like conservatism a little bit, but at the end of the day, I will let them do what they do. I think generally this company has had a tendency to be somewhat conservative in their guidance and then beat, which I don't really mind, but it does make the investment community a bit wary about maybe trusting the guidance that they're giving on the operating margin side. I think at the end of the day, if their gross margins are going up, their operating margins should go up a little bit versus the prior year. I know that there's some ERP investments they're making. They're making some investments in moving the informational technology systems related to the Hey Dude acquisition onto the Crocs platform, transitioning to a new distribution center for Hey Dude. All of those things will come down to the bottom line. And this is a year where they're investing in some of that, and there'll probably be more of a 1-year investment cycle, and operating margins should improve in the upcoming year. But given that they beat so much in Q1, given that their Q2 operating margins are above their full year guidance, I'm kind of feeling like 25% might be a bit conservative here. So again, I'm going to take a look at these Pringles shoes. If you want to buy this investment, you have to be aware that this is kind of what you're buying. They have weird shoes. Apparently this thing's sold out, so do with that what you will. I kind of think that that's pretty cool that stuff like this sells because there's collectors out there who collect these shoes. They do relatively limited releases, partner with a ton of other brands, and do a good job of marketing that stuff. If they could push some of that into the Hey Dude brand, if they could expand the Hey Dude brand into other areas of the country, like I'm in the Northeast and barely anybody wears that shoe around here. I think it's more popular in the Midwest. How do they make it more popular all around the United States? That's really the question mark I have here. Again, this is a company that grew a ton during the pandemic, like I said, kind of slowing down now, but I think it's still expected to grow at a relatively decent clip. And I think as the market sees that this growth story is not just a short-term growth story, that they continue to grow year over year over year, as they continue to see that the Crocs brand is not some fly-by-night thing, that people actually love it and are sticking with it, the valuation of this company will continue to go up because right now it still seems like a good value. Disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence and all of that good stuff. So as we look at the valuation here, we've got this $8 billion market cap, about $1.8 billion in debt and capital leases on the books, so about $10 billion in enterprise value. So about a 10% free cash flow yield. This is a company that produced about $814 million in free cash flow. Some more investments are happening in 2024, like I said before, so I think that's going to come down a little bit. But at the end of the day, they're doing a pretty good job of improving margins, investing in the right brands. They're really growing Crocs at an impressive pace. And if they can do something on Hey Dude to kind of revitalize that brand, then potentially this could be a really good investment for people who are even buying at today's prices. For me, I'm kind of being maybe somewhat conservative here, growing at about 4% for the next couple of years, down to 3% in the next couple of years with improving margins. I'm ending up at a 19% free cash flow margin, and this is lower than they have hit in the past couple of years. If you look at kind of their top end margins, they were in the low 20s. So I think I'm being relatively reasonable, maybe even slightly conservative around mature margins that they can hit here. They do have some pricing power with this product that they have. There's certainly some competition out there, some bootlegs, some, low end competitors that are kind of similar to what Crocs offers. But I think the Crocs cachet, the Crocs marketing arm, they've done a pretty good job in maintaining that. As they pay down debt, I think they're going to start buying back more shares. So I have about $1.3 billion of their free cash flow generated in the next couple of years going towards buybacks. Might be a bit conservative given that they already have $1 billion, almost $1 billion allocated. That's probably going to be happening in the next couple of years. So that might be conservative. Then as I look at valuation, again, a free cash flow yield of about 10% seems very, very fair given the current market dynamics. If you can get a 10% free cash flow yield for something that you think is going to continue to grow even at a slow clip and maybe improve margins a little bit, I feel like the market's undervaluing this for what it offers. I think it's still looking at this as a fly-by-night thing. Crocs, in my mind, is here to stay. I'm not 100% sure about that because if I were, I'd make this a much larger position, but I'm like 75% sure about that. So I think there's going to be some margin expansion here. And on top of that, growth. And because of that, I think the market's going to value it at a slightly better valuation in the future. So I'm putting 50% of the valuation in the 7% free cash flow yield, 50% and 8% free cash flow yield. And with that in mind, with these growth and margins assumptions and buyback assumptions, at today's price point of about $132, I get about a 10.8% return from here. So that requires two things: a little bit of a valuation expansion from the market and continued growth, even at a small clip, and continued margin expansion. I think those are all reasonable assumptions that I'm making. If I want a better return from this, if I want some margin of safety, so let's say I want to aim for a 15% target return, I get about $110 fair value. If I'm aiming for that 10% target return, I get about $138 fair value, which is right above today's price point of $132. So to me, this seems fairly priced right now. I think the uncertainty around Hey Dude is really what's keeping this down. Was not a great acquisition. I can't disagree with anyone about that. Don't love it. Don't love the results so far, but I do love what I'm seeing around Crocs. However, since this is already top 10 position for me, and since this is in an area that might be negatively impacted by any negative impact to the economy, any slowdowns on the economy, when people pull back from their spending, they're probably going to stop buying Crocs as much. I'd want a bit of a larger target return to build my position from here. And I think for me, if this hits about 110 bucks, I'd buy more, but I'm also very, very comfortable in holding and wouldn't call it crazy if you were buying at today's prices, because this is a company that's done pretty freaking well. You know, the growth overseas is really accelerating. They're doing a good job with their Crocs brand itself. There is some worry around Hey Dude, but there's potential there as well. If they can turn that around even to low single digit growth in the next couple of years, improve margins on that brand, this could easily be a pretty solid return in the future. And the upside here to me is that if they can do that, not only will you see better growth, so let's say I put in 6% growth in the out years here, but also the market might give you a better multiple for something that's not growing faster. And at that point, you're looking at returns in the high teens, low 20s. So that's pretty good. To me, the reason I like this investment is because the downside, even if it stays at the same free cash flow yield, seems relatively limited, an overall return of about 5%. And the upside, if there's growth, if there's multiple expansion, etc., seems relatively solid in the high single digit to low teens to even mid teens if Hey Dude can really be turned around. And they certainly brought in the right leadership to do that. So that's just my thought. Liking what I'm seeing in the earnings. Obviously, Hey Dude sucks. It is what it is. It just sort of sucks at the moment. You just have to hope that it turns around. But Crocs is doing so well that it really offsets whatever struggles they're having with Hey Dude. Even if Hey Dude ends up being kind of a bad investment, they end up kind of selling it off in the future or spinning it off or kind of winding it down for whatever reason. I think this still could be a good long-term compounder just on the basis of the Crocs brand. And you have the potential upside of the Hey Dude brand being out there as well. I just think they bought it at the wrong time. You bought it in 2021. You had all these shoe brands, direct-to-consumer shoe brands. I mean, look at what happened to Allbirds. This is a company that started at like a $4 billion market cap when it IPO'd, and now it's trading at $100 million or something like that. These shoes, the direct-to-consumer shoes, just kind of had this growth bump during the pandemic when everybody was at home and spending all of the money that they had. And now that the money is tighter, consumers are pulling back. But clearly they're sticking with the Crocs brand because not only did it grow, it grew at a faster than expected clip, especially overseas, especially in China, especially in Australia, where it doubled. So a lot of upside here for the Crocs brand. Kind of a question mark on the Hey Dude brand, but I'm hopeful, maybe not super optimistic, but hopeful as an investor. So if I had more clarity on Hey Dude, I'd probably buy a lot more here, but because I don't, I'm just going to hold. So let me know your thoughts. Let me know what you think about the video, etc. Let me know what you think about Crocs. Thanks for watching. Have a good day. Leave a comment down below. Subscribe, like, all of that good stuff. Bye.